I'm Danny Murphy with Danny & Associates. Have you ever considered purchasing an investment property? Over the years, many of our clients have come to us and asked us what the pros and cons are of buying income property. Often they want to diversify their portfolio out of just stocks and bonds, and owning an income property is like a fairly safe bond on steroids because of the significant appreciation that can be realized, plus the strong cash flow from rents. So today, I'll be discussing some of the questions you should ask yourself before buying an investment property, as well as talk about some of the financial considerations. So first, I'd like to talk to our clients about their investment goals. Are you looking for cash flow, long-term appreciation, or a little bit of both? Your answers to these questions, along with your budget, will help determine whether you should be buying in coastal Orange or LA County versus, say, lower-cost cities or further inland. Next, I think it's important to understand the short and long-term market trends as they pertain to prices, inventory, and interest rates. Since the market basically imploded in 2007, we've seen very strong appreciation. Over the past few years, we are seeing low inventory levels and very strong buyer demand. We also operate in a very international market with investors from all over the world. There's only so much land along the coast, so long-term demand has always been very strong in Southern California. Interest rates are still near all-time lows, so the money is still cheap. But the Fed has started to raise interest rates, and they've also indicated that they'll continue to do so at regular intervals over time, so you always have to be mindful of what interest rates are doing. Here's a good rule of thumb. For every 1% increase in interest rates, the average buyer loses 10% of their purchasing power. So I would argue that as a buyer, you should almost be more concerned with interest rate increases than prices moving up a few percentage points. Now, before you can buy anything, you need to know how you're going to pay for it. So let's discuss options for financing an income property. First, cash works. So if you have a suitcase full of it, go ahead and bring it. We can definitely help you find something. Next, though, get a loan. So while interest rates and the required down payment on a non-owner occupied loan will be slightly higher than if you were buying a primary residence, there are great loan programs out there right now for investors. You can also utilize money from a home equity line. If you have a home that's paid off or you have a significant amount of equity, you can likely get a large equity line and leverage your existing equity to buy more real estate. You can do a 1031 exchange, which allows you to defer any taxable gains. Perhaps you already own an investment property that you want to sell and purchase something different. Many of our clients want to consolidate their investments into certain areas, or they want to get into multi-units to spread out their risk versus condos or single-family homes. Also, did you know that you can buy a portion or all of a property through a self-directed real estate IRA? So it's very easy and it's inexpensive to set up, and there are several nationwide companies that can help facilitate the transaction. How about market timing? We always tell our clients, don't try and time the market. Obviously, buying at the peak isn't necessarily the best idea, but always think long-term with real estate. So it's not timing the market, it's time in the market. And then what type of investment property should you buy and where is a good question. You can do a single-family residence, a condo, multi-units like a duplex or a fourplex, or even more units. Next, you want to look at where to buy. Do you want to be close to where you live for ease of management, or a location that simply offers the best returns, no matter where that's at? Then there's demographic considerations. What type of tenants do you want to work with? Properties located in different areas have different income levels. There's language considerations. Do you want to manage the property yourself, or are you going to hire a property manager? Being a landlord is definitely not for everyone. So if you don't have a stomach for screening applicants, doing the lease contracts, and fielding the inevitable problem calls, then hiring a property manager is probably a good idea. Are you open to buying a property that needs improvements, giving you an opportunity to add value to the property? If you do that, you would need to have service providers, obviously, you can count on, but we can help you there too. Finally, and a very important question is, what annual returns can I expect reasonably from an investment property? The first component is net cash returns, which is really a fancy word for rents. The average on this would be probably 3 to 5% at least, depending on the purchase price level and the location of the property. The next component of your returns would be from appreciation. And long-term appreciation rates in Southern California have been at least 3%, if not 5% or more. So that's very reasonable to expect. So that gives you really a total return of no less than probably 6 or 7%, obviously more than 10 to 15% potentially. So remember, the returns increase with leverage. So if you're getting a loan and you're putting a lower down payment, the returns are going to increase with that leverage. So call us anytime. We're happy to answer all of your questions, including connecting you with great lenders, directed to your real estate IRA administrators, property managers, and of course, my team can help you find the right investment property at the best possible value. Call me anytime at 949-413-6967 or visit our website at www.thesocallife.com. Thanks.